Hello traders, Bill Duryea here with the trade strategy review for Thursday, July 18th, 2013. We'll do a quick recap of the context of today's session and then we'll jump into the micro developments that occurred during Thursday's auction. First of all, in our daily market recap, we put more time in explaining the context, and it's often productive to listen to the daily recap before you get into listening to the trade strategy review, particularly if you're new at analyzing the market. You might find that there's some benefit to that. We had support develop on July 12th down at 1666, and the S&P had pulled back to there on Wednesday and auctioned up in the overnight session and retested the high at 1678.79, made a modest higher high. The midpoint, the median of the developing trading range, was down here at 1673, 1672, and overnight the market pulled back to the midpoint of the range, and prior to today's open, price auctioned back up to retest the high and went on to make a higher high. Before we go on, I'd just like to point out something here regarding the market structure and the charts that we put up on the website. So notice where I have this blue arrow. To traders who use auction market theory and or Gaussian mixture model, which is kind of the quant version of market profile, market structure is an indicator. It's the most factual indicator that you could have. It tells you exactly where the selling pressure ended and where the buying began. And I typically locate the arrows right where the selling occurred so that it's very easy for the eye to identify the pattern. So here again you see at the low, and similarly overnight the market auctioned up and then broke out above the prior high. This is a transition point. There was a 2-day consolidation, you could even argue a 3-day consolidation pattern, and the market transitioned or broke out above it and traded up to a new multi-year high. I want to stress this is a new multi-year high. Today's maximum likelihood expectation price level was 1692. The cash traded to 1693. The extreme price excursion level was at 1700. If you're not familiar with these terms, maximum likelihood expectation, extreme price excursion, you can go online and Google these terms. You'll find lots of papers on them, good Wikipedia links. Similarly, we indicate here where the market sold off. There were two highs right here, the factual high and then the secondary high, and this is where the market failed to extend the trading range and auctioned back up above the current rally high. Now we'll take a look at the 5-tick chart. 5 ticks is the minimum range chart that I use. I've used the 5-tick chart now for the, better part of 10 or so years. There's a certain preferential element to all charts. Some people would want to make the chart smaller, 4 ticks. 3 ticks is obviously the minimum. Why? Because 2 ticks are neutral. So if price goes up a tick and down a tick, up a tick and down a tick, it's neutral, right? 3 ticks is the minimum because that indicates at least there is one break in the price sequence. In other words, it had to go directionally at least up to or directionally down to. I began using a 5-tick chart after a long-term study I did on the E-mini. And in that study, I did a query of the data, and I want and when I did that study and queried the data, I found that after the market moved 5 ticks, it had the first statistical significance in terms of potential minimal directional outcome. But there is no hard or fast rule saying that you have to use a 5-tick chart. So if you have a different preference, by all means, use whatever you prefer. What I like about a range chart is that they eliminate time. And time is one of the noise components in the market. So time introduces an element of noise, and it doesn't necessarily indicate change. And what are we really concerned about? Change. It doesn't matter if you have a 1 minute, a 10 minute, a 30 minute. If price doesn't change and the range remains the same, you'll have a whole bunch of bars that mean nothing. If you're using some kind of smoothing algorithm, be it a simple moving average or a digital filter, and let's say you have a look back period, something like the standard 13 period look back, and you have 13 1-minute bars and they didn't change, well, your average then is gone because you have no, you're calculating something redundant. Whereas if you're using range, if the market stays in a range for an hour, it doesn't affect the smoothing average whatsoever. So that's one of the reasons why we use range charts over time. And you can see they give a very clear line as to where support, resistance, and turning points occur. So let's focus here just on today. First of all, as has been the case for the better part of a month, the best trade opportunities occurred overnight. The market pulled back overnight to the median point, the midpoint of the developing range at 73.72, made a little lower low, but support held, and the S&P auctioned back up to the prior high, and this occurred just prior to the open. The best buy at the open was at 16.78, and if you were trading prior to the open, you had a couple of opportunities to get long at 77 and 76. Then on the rally to the high, price traded above the transition point and auctioned up to the new multi-year high. Now the rally to the new multi-year high stalled prior to auctioning up to the maximum likelihood expectation target. It stopped a good 4 points below there, and there was a minor downtick backed at or near the breakout point, but the market failed to auction back and continue higher. And then on the subsequent pullback, price traded below the minor micro intraday support that developed there at the 82s and went on to pull back to the prior high at or near 78.79. Before we move on to looking at the order flow events, I just want to point out here that the developing trading range from the low at 66 is 22 points. If you attend our live broadcast regularly, you will hear me talk about the 17 to 23 point price range. That is part of what is called the hidden Markov chain. There are different price levels from which you can run the measurements. The maximum likelihood expectation target that I had plotted today was based upon two references, and that was the parameter using the overnight low, and the second parameter I used was yesterday's close at 75. Now let's move on to today's order flow events. So this chart here shows the overnight price action. If you've gone through the links on the website, you'll notice that I also post daily a market commentary. And in the market commentary, you'll find I post an executive summary on what took place in the Asian markets and in the European markets. I'm on the West Coast, so I follow the Asian markets closely. The Asian markets were selling overnight. There was negative data out of China. And I actually thought when the market came down here it was going to break down and sell off. I went short here, and this just dragged on. You can see nothing happened. It just dragged on, and then finally when the market upticked, I decided, okay, the heck with it. I was going to go to bed, and I took the position off and fell asleep. I didn't want to buy it because by that time I was too tired and didn't want to be up anymore. But I thought that there was a possibility because of the negative developments out of China. The Chinese economy has been slowing down, and that's obviously the main economic engine of the world at the moment. And so there was no breakdown, and then sell programs waning occurred. Had this been during the normal daily session, I would have bought that. That would have been a buy we would have talked about in our live broadcast. Before the open, the market was back up here again at or near the high. It was during this period of consolidation. This is when I get up. I'm usually up at 4 in the morning. So this was the period of consolidation. And by that time, the European markets were showing a positive bias. And so it was obvious to me at the time that there was a likelihood that the market would retest the high and possibly make a higher high depending upon the economic data that came out today, whether or not it provided a catalyst to attract buyers. When the S&P finally auctioned above the prior high, you had the exponential price series accompanying the breakout. Now, often you'll hear me talk about breakouts requiring an exponential component. This is what the exponential component looks like. If you're thinking the market's going to break out and it's at a high and you're buying it, and the pattern emerges like this, that's not going to be a breakout. You may get a little range extension, but that's not the breakout exponential pattern. Here's the exponential pattern. Higher highs, higher lows. Look at the sequential higher, higher, higher. So this is what we look for when there's a breakout. And so you don't want to be looking to short too early when the market is breaking out. You want to let it run. And there was a curve here because the market was semi-flat prior to this, and this is the inflection point. And in today's broadcast, we put forth this question: what will the sellers at the prior high do when the market initially pulls back? There were obviously people who were short at the 78, 79s, and this morning there were traders who didn't think the market would break out, and they were selling the 81, 82s. Obviously they got offsides. As part of our Bayesian logic, we asked the question, what is the likely outcome when the market pulls back the first time? Are they going to jump right away on the sell wagon and keep selling? Or are they more likely to exit their positions, resulting in the market upticking at least back to the median point of the cluster and possibly retesting the high? Now I know we have a wide range of members. Many of them have been in the IOAMT room before, and they've heard this a million times because I repeat it that often. But for those of you who are new, if you had no idea what to expect, then make a copy of this chart. This becomes your empirical evidence, your observation, and we discussed in detail how you go about collecting observational data, and you save that in a folder, and now you have, if this was your very first time seeing it, you have at least one example. That's not enough for you to draw a solid inference on, but if you had 20 examples or 100 examples where this type of event occurred, and you could see that 90% of the time on the pullback, price upticks at least back to the midpoint of the range and attempts to retest the high. That's money in the bank. So that's why we encourage you to take note of this so you don't forget. The second question is, do you want to sell the high? This is something that you'll hear traders talk about all the time, especially new traders. They'll say, oh, you're going to fade the trend, don't fade the trend. And sometimes it's not wise to fade the trend, right? How do you know if it's good to fade the trend or not? Now today I was prepared to fade the trend or to sell the high, but I was looking for the market to auction up to the Markov chain level at 1692, and from 1692 on I would be a seller. Now that didn't happen, but the next time we trade to a Markov chain, I'll make a point to highlight that in our after hours trade strategy review and talk about that in more detail. First of all, on the rally to the high, you had buy programs waning. So I look at this from, I was long, I looked at this from the perspective of I should probably get out of this trade now and take profit. That's how I used this information. It could have been, because this is what a pause at the high looks like, it could have also been used as a rationale to go short as long as you were prepared not to defend above the 88s. And this was a better place to short than just on the buy programs waning, because first of all, you had a high frequency sell surge, and on the way up you had more high frequency sell surges. And then finally the curve turned. So where did the curve turn? It turned here. This is the upper inflection point at 87. We use this today to infer where the market would stop on the way back, and that became the level to take profit on for the buyer at 82. On the way down, you had high frequency selling or initiated selling, high frequency selling. You could have even sold late. It feels awkward sometimes to sell late, but you could have sold late, since that is a trade that Carl Weiss can explain better than I. I didn't take that trade. I'm not going to go into the details on that, but I'm going to encourage Carl to do a response video or supplemental video on this segment here, because I think this is worthy of further discussion. Then the market pulled back to the inflection point. There wasn't any sell programs waning event associated with the pullback, but it was the targeted area, and the high frequency buying followed the initial pullback, and that confirmed that you could get long. Again, not wanting to defend. Why not wanting to defend? Let's talk about why not wanting to defend. While the previous high was 1680, and in the morning the stop action, the little stalling that occurred, was at 80 to 82. Really the high, as you saw in that previous chart, I mean where people were really selling from, was really 78. That's really where they were selling from, 78. I mentioned that in many of my market structure commentaries. That's really where the selling had occurred, at the 78s. And so during price discovery, you had to be prepared that the market could probe down to 78, 79. And so, not wanting to get overly attached to this, you would not have wanted to carry that position down to 78, 79. That's too many points to carry down. So therefore, this is not a defendable area. Had the market traded lower, this would have required scaling in, exiting the twos, seeing where the low was, repositioning the order. Let's say the low was 81. Repositioning the order. Filling 81. If it went up only a little bit, like 2 points, and then came back through the 81s, exiting the 81s, seeing where is the low. Oh, the low is going to be 79. Great. Buy the 79s. That's how one way of getting in. Now, someone might say, well, why not just be selling? Well, you could. You could have just been selling those levels too. I mean, that's the other side of the trade, right? And I have annotated charts like this. This was a discipline I developed as soon as I started trading. So I probably have at least 10,000 annotations of this pattern here. And so start your collection, right? There money in the bank. You don't then have to guess. You know, okay, here's what I expect, and here's why I expect it. You need your own observations. We're happy to provide this commentary and discuss this with you. We encourage everyone to think for themselves. If you have at least 100 observations and you've taken the time to annotate your charts and you know what to expect, you will be confident. And if you're doing something just because another person is doing it or someone's telling you to do it, you will not be confident. So that's why we are insistent in this aspect. Don't be a follower. Think for yourself. You need to be able to answer that question. Now, think of it in another way. Suppose we were in a court of law and someone said, and the question is, what will the seller do at the prior high? And you said, well, so-and-so said. That would be inadmissible. Why would that be inadmissible? So-and-so said the seller would do this. Because that's considered hearsay. This means it's not adequate evidence for you to arrive at a conclusion beyond reasonable doubt. You have to be able to arrive at a conclusion beyond reasonable doubt. Hearsay is not going to provide you with confidence. Your own observation and your ability to say, honestly, based upon your empirical observation, I have seen this many times, and I know that it's likely to do this. And if it goes down from here because this is a trend to a new high, I'm confident I could manage the trade. You have to be able to say that on your own, not because so-and-so told you. So that's very important for new people. Now, here are the market auctions back where? To the inflection point at 87. So there's the other reference we talked about earlier. Here's the rally back to the inflection point at 87. And as we noted in the room, retest of the high, no higher high, and the failure to retest the high fully and make a higher high. We discussed this in the live broadcast. The implication there is that the market could auction back down again to the low and possibly make a lower low. And that was the reasoning behind our statement in our live broadcast that buying the low the second time was not recommended. The price could potentially make a lower low and trade down to the prior high at 78.79. And indeed, at the close of today's session, that's what occurred. So that concludes our daily trade strategy review. I hope you find these worthwhile. If you have any comments on them, if there are things that you would like me to elaborate in more detail on, you can reach me through the forum on the website. So if you have questions you want answered in more detail, just type them into the forum and I'll be happy to answer them. Thank you very much. Have a good night.
Follow the Bots offers a completely new approach for traders. Follow the Bots provides you with tools that will allow you to trade with the bots and not against them. To learn more, take a tour of www.followthebots.com.